Okay, welcome everybody. My name's Trevor. I'm with MarketDelta, and this is our special webinar, Making It Easy to Read the Footprint Chart. I'm really excited about this. We did a similar event, although this one's much more updated and there's a lot of new content. We did a similar event like this back in October, and it really was helpful for a lot of people. And so I want to go over a lot of this today. Got a short intro, and then we're going to jump in. Really, a lot of the time today will be spent going over real world examples and showing you what to look for and how to apply it. And so that's that's what I'm expecting. It'll probably go an hour and a half though, and it is being recorded, so you'll get a link tomorrow to download or view it. So let's just jump right into it. For those new to MarketDelta, we're the creator and inventor of the footprint chart. This is something we created. We actually started the company a little over 10 years ago. So we just had our 10-year anniversary last year, and we're excited for what the next 10 years hold. We're a leading market profile reseller for CME Group. So we have a really robust market profile functionality as well. That's not something I'm going to really be referring to or talking about today, but I want to let you know that exists. And we're a trading and charting software company. That's what we do. We develop tools and charts to help you guys all achieve your goals. So what we're really focused on today is talking about the volume imbalance footprint. And to talk about the volume imbalance footprint, it's important to understand some of the differences and what it is. It's not just another footprint type, although it is, but there's a lot more to it. And so I want to describe what that is before we dive in to what it looks like on the charts. Now before I go any further, just a couple people, can you hear me? I want to make sure everybody can hear me. There's one person saying they can't hear me. Okay, good. All right, okay. All right, so the volume balance came out of years of experience and our understanding of the footprint chart. Like I said, this is something we created 10 years ago. There's been a lot of work that's gone into it, and one of the things that people have always struggled with, because it's not a typical open, high, low, closed bar, is they've struggled with applying it. And so what we've done is taking our knowledge of how to use it and trading with it and talking with thousands of traders over the years, we've come up with some logic that can be applied to the footprint. We've just written it right into it so that you can see it and react to that information and apply it how you trade. So this applies to both a novice and experienced trader. A lot of our customers are professional traders, prop traders, and so if you're one of those guys, I would don't leave, because you're definitely going to get a lot out of this. But for those who are new, I think you'll find a lot of useful information as well, because it's a great starting point. It's an easy way of making use of inside the bar data, so you don't have to interpret all the numbers so much. Let the volume imbalance do the interpretation, and then apply it at your levels. And we're going to look at a whole bunch of those examples today. It uses an algorithm to identify these imbalances, and I'll explain what these imbalances are here in just a moment. And because it does all this, it simplifies reading the footprint. So that's the whole idea. And last but not least, it clearly identifies the fuel, which is volume, in the market. So here's the traditional methodology for the footprint. The traditional methodology, I just want to show it because you've probably seen it and it's all over the website, is it simply compares the bid traded volume against the ask traded volume. This is how it's represented. Bid traded volume and ask traded volume. So this would represent 431 contracts traded on the bid at this price, 502 traded at the offer at this price. And then the shading of the background, this light blue, represents the dominant order flow. Was there more aggressive buying, more aggressive selling? And so this is the way we've done it. and this will continue to exist, and it's very, very applicable. However, the volume imbalance, what it does is it's comparing the relationship of order flow between what traded here on the bid and what traded on the ask. This will make sense as we move through this. So instead of showing or comparing the bid traded volume and ask traded volume at a single price, we actually look at the relationship between what was the bid, what was the ask, and what that order flow was. And it actually turns out to produce very valuable information. So here's the volume imbalance methodology. We compare the bid against the offer. So this is actual volume imbalance footprint, and it's represented the relationship. We're looking at how much traded on the bid and how much traded on the offer. And then what we do is we shade the numbers, either green or red, to indicate the dominant side. And the dominant side is where the algorithm, that's what the algorithm's doing. It's trying to identify these important imbalances and give you a cue. So clearly you don't see imbalances at every price. It's looking for them and then signals when these imbalances are achieved. So again, going back to the previous slide, it's comparing bid traded volume here against the ask traded volume. And so the next slide, this is the relationship. This is how it's comparing these. Now this is kind of the bookwork of it all. We're going to get into the application, and that's where that's the value of this. But I want to make sure everybody understands kind of the bookwork behind it, so that you understand what you're looking at. It's important you know what this is. Okay, so the strong ask volume is the buy volume imbalance. That's typically green or blue. Strong bid volume is the sell volume imbalance, typically red, and that's the aggressive selling. And then we use the term weak volume. That's typically navy or silver. This is neutral volume, and you can pretty much ignore that. The idea is to know where these imbalances of strong ask volume or strong bid volume come into play. So going back to this screen, we're looking here at this one, and then this one. There's a strong bid volume, which is aggressive selling here, and then this was the buy. Okay, so here's a good question from Bill, and I probably should have clarified this. The footprint shows you traded volume. That's all it shows. It's not showing you the depth of market and how much is available. It's actually showing you how much traded. So anytime you're looking at a footprint chart, and this is one of the real benefits of the footprint, is that is traded volume. It's actually how much happened, how much traded in the marketplace. Where if we go back to the dome, which this is the dome from MarketDelta Trader, the dome just represents what's available. And as the market is bouncing back and forth and trading these prices and chewing into this available quantity, that's what the footprint captures and displays. Okay. So here, let's take a look. Let's just kind of dive into this a little bit further. Taking this example bar that we were looking at, you can see I've put the arrows where you'd see the strong bid volume right here. And remember, it's looking at the relationship between this was the bid in the marketplace, this price, and this was the ask. And it's watching the market as it's trading and what that imbalance is. When it hits a specific threshold, that's when you get a color. And you can control what that threshold is. But I'm not talking about the details like that right now. I want to focus in on the relationship. And so what you'll see is you're going to see in all these examples, and I didn't cherry pick these examples. They're examples, most of them are from today. I just went into the ES and found examples. I was trading it today as well for a little bit, pulled some examples from there. So we'll take a look at some real good examples. Here's the strong ask volume, and this lights up when the imbalance is much more on the ask side of the market. So here was the bid. They traded the bid 251 times, and the offer 398 times. There's an imbalance, and we signal this. Okay, so I have Anthony answering some questions. So I know there's questions rolling in. He's helping me out here today, and I really appreciate that. I do plan on answering questions later on in the session. So if your question doesn't get answered right away, I will be trying to address that a little bit later. So now we're going to really jump in. Now that you kind of have at least a cursory knowledge of the background of what this is, let's take a look at some real-world screenshots, and this is where a majority of our time will be spent. And I will be explaining this further as we go. So let's take a look first at reversals. And I'd like to, maybe before I get into it, I like to think of the market as from a trader's standpoint. I like to think of the market, and there's different types of markets. There's trending, and then there's congestion or sideways markets. Those are the two big ones. And then there's reversals. That's something that happens in markets, and it happens in the micro and the macro time frame. But reversals are actually one of my favorite applications for this footprint type. And one of the primary reasons, of course, is the risk versus reward. I can quantify the risk within a couple ticks typically, and the reward can be big if you happen to catch a low of the day or high of the day, and you can ride the trade or whatever. But we'll take a look at some of these. So these examples are reversals, things you want to watch for, and I'll point them out. You want to watch for volume imbalance color shifts at support or resistance levels. So before we go any further, the way to apply this, the footprint, the volume imbalance footprint, is not a system. I'll repeat that. It's not a system. It's a chart, but it's a chart that's providing you inside the bar information and allowing you to react to volume and order flow at these key prices. Well, when would you use that and react? You would react at support or resistance or levels. So practically any trader has levels that they're familiar with. They're stuck in their mind for the day. They have them written down on a piece of paper. They have them up on the chart. Maybe they're fibs, maybe they're value areas, maybe pivots. It doesn't matter. The point is it's a level, and it might be a zone. And what you want to do, and the way you want to apply this information, in all the examples we'll look at, you want to envision you got a level, and you're looking to qualify that level. You want to qualify that trade. How do you do that? And you're going to see how you can do that today. So volume imbalances make it easy to identify shifts in order flow. And remember, this isn't a system. This is simply showing you a better way of viewing the information because you can see inside the chart. Because you can see inside the chart, you naturally have a better view of the competition. A better view than they do. So here, first example, this I think I pulled out from this morning. We'll look at a bigger picture view of this in a moment. But what the market had rallied up, pulled back, and then tested up into this. You see this band? See this gray band? Hopefully that's coming through in the screen. That gray band is a resistance level, is a zone, is a 4-tick area. This was the ES. And what I was looking for was to get short up in here, potentially work an offer or just get short for some sort of move back down. This was an actual trade I took. I sold, I think these were 875s or 8.5s, I forget. But what triggered was, one, I had a level, so I was looking for a short. That's number one. Number two was, and I was patient. I could have tried to get in here, but I didn't. Let the market trade, do its thing. When it traded up here, and I saw this imbalance occur, and I saw this yellow box on my chart. These are my charts that I took these screenshots with. This yellow box is simply the high volume point within the bar. When I saw all this volume coming in up here, and then I saw the imbalance occur, it was a worthwhile trade, and knowing it was up against this resistance level, I took the trade. And You can manage it from there how you want. This webinar is not about managing the trade. If you're trading multiple contracts, you may you may leg out, take a quick profit on some and let others ride. If you're just trading a one lot, which nothing wrong with that at all, that's going to be up to you to manage it. Maybe you have just however it is. If you like to take one trade a day, then obviously you're going to want to try and get a lot out of that trade and be very choosy on your trades. Either way, this was an opportunity to take, and this was the trigger up against a resistance level that I had identified. Now before I go any further, discipline is key. You have to be patient and you have to have discipline, because you're going to see these things light up and you have, like, is this an opportunity to take the trade? Do you take this short? And I would say no. Why? Because I'm being patient. I want to see if the market comes up to here. If it comes up here and does it, I'll take the trade. If the market never traded back up here and sold off, am I frustrated about it? No. I'll have another one. There'll be another trade at some point. I'm not going to worry about it. So you have to be patient. You have to have discipline. Use this as a qualification trigger at those levels. There's no better way to do it. Next example. Now this one is kind of combines a reversal, some things you can look for, but also how to really confirm the reversal's intact. So here's what we're looking for. The market had traded up, and I just labeled these bars 1, 2, 3, 4, 5. And this wasn't from today. This was from I don't know. This was a screenshot that I'd shared out with somebody that I had handy. So anyway, market had rallied up. Notice as the market traveled higher, notice our buy imbalances. That's these green ones. So it shows us, and it's confirming the dominant trend. Traded up to these 9s. I forget if this was resistance or a level that I had. Clearly I didn't have my band on here. But the point is, traded higher, and we get this within the one tick of the high. And then it's confirmed again within the bar. That's pretty convincing, especially after a move up where we haven't seen hardly any sell volume imbalances. All of a sudden we get 2 within the bar. Next bar opens with 1, and we see further sell volume or sell imbalance. Okay, so what we're looking for is this up here where the market had traded. Each time it was trading higher, and then we get this one that steps in. This one really confirms it, and this is where you maybe end up getting in the trade. Now there's different triggers, different ways you can apply this. Some people would take it on this, and actually that's a lot of times what I'll do. Why? If it's up against the resistance level that I've identified and I feel pretty confident in, I'm okay taking a chance up here. And the reason is my risk is I only risk a couple ticks on it. You could risk a point or 2, whatever you want. Depends on what you're looking to get out of the trade. But these are the types of trades I'm looking for some sort of immediate reaction, typically because of that imbalance. So here you could use this information to stay short, potentially add to the short, just to help you manage the trade. There's nothing like getting good location on a trade and then seeing the sellers, if you get short, seeing the sellers come in and confirm that. That adds a lot of confidence. And I always, well, I don't know if I've ever really said it in a webinar, this applies not just in trading but in life. Let's use the real estate example. You make your money on the purchase. What do I mean by that? You make your money, if you go to buy a house, don't just pay whatever. Really negotiate to get the best price. Because let's say you plan on selling it in 5 years. Don't think you're going to make your money in 5 years. You make your money on the purchase. So the idea is you want to really get good trade location on your trades. Because if you get good trade location, the market can sit right around your area and just dance around, and you're okay. You're okay. You're not having to take any heat right away. The worst thing is you get in a trade and immediately it goes against you, and then you're stuck with a loser right away. And the fact is, if you just had a little bit better location, it might have been a great thing. So you make your money on the entry. Think of it that way. Next example. So this was a trade from the pre-market this morning. Low risk, high reward trade. This was pre-market, so the market had come off, and I wish I had the price scale. I don't have it on here. But here's what we're looking for. It's the reversal trade. And you could say this is sideways congestion, so it kind of falls into that category as well. This is a 5-tick reversal chart. 5-tick reversal, ES, that's my periodicity. And I love this one because the market trades down, big move, a lot of momentum here. Kind of bounces, it doesn't trade to the tick. This one does, and this one's the beauty right here. Trades the low to the tick, and what do we see? We see this buy volume imbalance. If nothing else, that's a nice scalp. And what do I call a scalp? A point. 4 ticks. You could go 2 ticks. That's going to be up to you. But for me, I'll usually look for a one point on a trade like this, and it can happen fast. So you got to be nimble. But the idea here is we get a buy volume imbalance. The market did bounce, comes back right to this where we got this imbalance. Trade's just 3 contracts. I'm not going to make a big deal about that, but we get another imbalance. That's confirming the market is bottoming out. When it comes back down to test these areas, we see buyers step in and take advantage of these prices. And you can see this thing. These are nice trade opportunities. Now if we could look at a bigger picture, you may be getting in down here at these lows and be able to ride a big move up. The point is this location. You're looking to qualify the opportunity to get in instead of buying a breakout three points higher and hoping that it continues to go in that direction. Okay, again, these red boxes, that's the high volume price. That's what this is. I know in some of my other charts I had this is yellow box, but it's red here. Let's move on. All right, so this is okay. Remember the first screenshot I showed? We were looking. I had a band. My band was up here, and I told you I'd sold here. Market came down, and then I got this. Now I actually had covered up the position as it traded down, and I think I may have got long here. I think I did. And why? The market came back down, and it's not, you have to read the numbers here. I was using this, you see these big numbers? This was a high volume level within the bar. If I could turn this into a volume profile, there'd be a fat node of volume right in this area. Came right back into this. And I got this. So again, this was a scalp. I wasn't looking to necessarily ride this the rest of the day, but trigger. Nice trade opportunities, limited risk. I can risk a tick or two, and I'm comfortable with that. Now, the market had rallied up here, pulled back, tried to go higher, and then failed and came back down. This type of, this right here, you could use this as an opportunity to buy the pullback and join the bigger trend. So if you were identifying the market potentially as a trend day with a lot of potential to go higher, and you're looking for a good pullback to get good trade location, this would be it. Let's face it, it's not comfortable buying the high, hoping the market goes higher. Sometimes you got to do that, but you need momentum in the markets to do that and see it work. Ideally, you want to be able to identify these pullbacks, and when you can step in and take advantage of that. All right. Okay, so I see there's questions. Anthony's doing a good job answering. There's some I'll come back to. So I haven't forgot the questions. Okay. Okay, another example, I think this is the last reversal example. This one is from crude oil, actually. This was not today because I can tell from the price we're a couple, $4 or $5 higher, I think, than here. But this was another example I believe I'd sent to a user. And what we're looking for here, again, are these yellow boxes, or is that high volume level. So that's just useful in tracking kind of value within the bars. You know, is it moving higher or moving lower? And typically in an uptrend, this is just a simple rule here, worth always paying attention to, and it's why I like having it on my charts. If the market's moving higher, I like to see that high volume level migrate higher and higher. It tells me that it's drawing in participants at higher levels. The bulk of the volume is occurring at higher and higher levels. That confirms a trend. That's like rule number one when it comes to volume within trading. And when that begins to level out or reverse, that's good information, because it tells you the market might be starting to stop. You're seeing actually volume accumulate below levels that previously existed. So the actual imbalance that I was looking for right here was this one. So you could see the market had traded down, step, 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 step. You can see some real imbalances here. It really picked up steam. This happened real quick, I'm sure. So that's confirming that. And then we trade down to take a look at this volume breakdown down here. And you can see the volume breakdown really spikes and starts to turn. This could be used as a trigger. Now it depends on how aggressive you're trading again, but the fact that we get a spike down in the volume breakdown, which is an built-in indicator in all versions of market delta, with this, and maybe you wait for this bar where you get another one with a step higher in that high volume node. This is where it can become potential opportunity to step in and look for a move in the other direction. So I'm not going to talk too much about crude oil, but I want to show this can be used in other markets, not just the ES, although a lot of the examples I'm showing are of the ES, and that's mainly because I was doing a little trading on it today, and it's easy to pull examples out of a market that you're actively engaged in. Somebody's asking the settings for this chart. I think this was a 6-range bar. All right, let's jump into some range-bound and sideways markets. So the reason I'm big on identifying or trying to identify what the phase of the market is, whether it's range-bound or trending, is that tells you kind of your posture. That's just a term I use, the posture of how you should be trading. So in a market that's trending, I'm obviously trying to find pullback opportunities or willing to buy breakouts. Now I'd rather buy the pullback, not the breakout, because breakouts happen so fast and it's higher risk trade. Whereas a range-bound market, I'm looking to sell tops or buy bottoms. So the market's moving sideways. I'm more reactionary versus being aggressive. So what to watch for? We watch for price extremes of the range, and the great thing here with a footprint is you have intra-bar information to let you do this. That's huge, and you don't hear that talked about much, but being able to look inside the bar or see inside the chart for these clusters or these triggers, these volume imbalance triggers, gives you a huge edge, because you're able to look inside. Most people, let's face it, guys, you're really a select group of people in the world, of the trading community at large, that's even aware that you can see inside the bars like this. And being able to do so gives you a huge edge. And if there's one thing, just one thing you apply, take what I'm going over today, study it, and really try to apply it at your levels. If there's one thing you leave with today, just do that, and give it some time, be patient with it, and I think you'll find it very, very helpful. Some of the other things we're looking for here are stuck longs, stuck shorts at these price extremes. And I'll show you some examples of what that might look at. That's something that Anthony in our trading room is very good at identifying and showing. A clue: volume imbalances tend to be at the extremes, so that's one of the things that you can look for. So let's jump in. No sound. Can you guys hear me? What I was getting into was a congestion sideways market. So we're moving from the reversals to the sideways or congestions. What do we look for? And like I had said in the previous slide, which let me jump back. We're looking for price extremes in the range, and you got that because you've got the interbar information with the footprint. And you can look for stuck longs, stuck shorts. You can look for volume clusters at these extremes. But let's look. Okay, so here's an example. I know I took a whole screenshot. I know it's probably small on some of your screens, so try and zoom in if you need to. But specifically, I think this was another trade. This was another scalp. This was a scalp that I took, which is why I took a screenshot of it. But these levels, you might ask, I want to make sure I'm telling the whole story. This was right after the open. This was 8:30 Central. The market opened right here, traded, went higher. And this purple line is the value area high. This is the POC and the value area low. And what I wasn't leaning on it too hard at all, but I was really leaning on these triggers. I'll call them triggers. These volume imbalance, sell volume imbalance triggers. So one time, two times, the third time up, I took this trade. Now there was some risk to it, but I had a tight stop, and I just looked to. It took, I think, 2 or 3 ticks out of it. Not a big trade. But I want to show you how you can use this. Now that's for a scalp. You could use this obviously for the a bigger trade and risk more, of course. Here was the same thing on the downside. So it was just bouncing around. This was over, about a 10-minute time frame, and just scalping it. That's all this is. Now you could use this again on a bigger time frame, but I want to show you because these are some actual trades that were placed. Okay, next slide. This one was from the NASDAQ. This was not today. We had a defined congestion area. And in this one, I wasn't necessarily playing the congestion. I was playing a move out of it. And so what does that look like? Now, it doesn't always look like this, but I like the volume volume breakdown. I have that added here at the bottom. And what I was seeing is the volume imbalance, the volume breakdown is turning positive while in congestion. So the longer the market goes sideways, the more likely it is to break out at some point. It just will. So we're looking for clues as to which way it might go. So you can use the volume breakdown to give you bar statistics as to what might happen. But looking intra-bar, this is where the clues stand out. I'm seeing some pretty good buy imbalances here and then here. I like that. So again, I'm willing to take a trade. Ideally, I'd try and buy it down in here, but because it's a breakout, I may take a little more risk and just go with it, either at the breakout or try and anticipate it. And so you can read what I wrote here. Buy volume balance develops within congestion, providing a hint at which way it'll break out. We hadn't seen any of that leading up to that point. Another congestion. Now these are obviously, these are scalps. These are short trades, short time frame trades. But I always encourage people, just be patient with it. I wouldn't necessarily take every single one of these trades. And you usually aren't going to see them light up like this. But I want you to see what these are the things you look for. So at the low of a range, we're looking for these buy imbalances like this. Like this. Like this. At the top, at the high of the range, we're looking for sell imbalances like you see here. However, what I don't like on this is there's also a buy imbalance. So the way I generally treat these, I just cancel them out. I wouldn't take this trade. I wouldn't take the short. Yes, it proved to trade down, but that's okay with me. I'll pass. Live to trade another day. That's all that matters. Can't get greedy. Be patient, be disciplined, because those are the traders that win. Those are the ones that come out ahead. All right, so let's look at some trends, some continuation patterns. So here we want to follow the volume imbalance. We want to stick with the dominant order flow, and it does an excellent job at showing us that. So we want to let, of course, price in a trend is moving in a direction. That's what trend means. But if you're on the trade, if you're in the trade, let's say you're in the direction, you got a position in the direction of the trend. Like I said earlier, there's nothing better than seeing that confirmed, not just in volume, but in order flow and price direction. That really can add confidence to the trade and help you get more out of it. I mean, the value right there, just having confidence, because many traders, and talking with traders for a long time, a lot of traders lack confidence, especially initially, because it's hard to get something working. And if you can really find something that can give you some extra confidence to stick in the trade, or not get in the trade, just stay out of it when you probably shouldn't be, that's a very valuable tool. So we want to identify the trend and we want to ride that. We want to look for a reversal of trend to lighten up your position. We'll take a look at some examples there. And then we want to let the volume imbalance keep you on the right side of the market. It's dangerous to fade. So if you're seeing, well, let's just look at some examples. It's very dangerous to fade if you've got volume balances running right into you. So here I've got a resistance band up near these highs, and I had a support level down here. And so the market traded down into my support band. Remember, this is a 4-tick band, so I may stagger orders throughout. Or I don't got a set pattern of how I do this, but in this case it traded down into it, and we've got a volume imbalance. That's an opportunity, at least for a scalp, a bounce. And that's what happened. That was a nice little trade. I mean, this is from here to here is 2 points. Now I wouldn't capture that much. I might capture a point, but I'm perfectly happy with that. Bounces around. Does the same thing. Doesn't trade down into it, but we get this imbalance. And then another one. And then, boom, off to the races. Now this is a 5-tick reversal chart. For those who are probably wondering what this chart is, it's a 5-tick reversal. So it's like a point and figure methodology. So this shows a strong momentum. It wasn't pulling back more than 5 ticks with this whole move till it got up to here, and this happened to be our resistance, our target. But what's the point here? What are we talking about? We're talking about a trend. How do you trade this? Now these were these nice reversals. We've already talked about this. These are beautiful patterns. These are the trades more often that I take. Into support, I get my trigger and I'm on. However, let's say I'm on. Let's say I took this one. Where I took this, I got in down here because it's a second retest. I'm getting some confirmation from the buyers, and I'm long. So let's just say I'm long right here, and all of a sudden it starts trading higher. Okay, well this is good. I'm feeling confirmed in my direction or in my position because it's moving in my direction, but it's also, I'm seeing these buy imbalances. It's perfect. So what do I want to see? And so that may give me some the ability, holding power to hold it. Not until I see some sell imbalance do I maybe take off the trade. Although I'll be honest, I'm not riding it from here all the way up to here. Maybe in my last one I am, my last package. But let's say you're trading a 3 lot, might take one off at a point, one off at 2 points, and let the other ride until I get my trigger in the other direction. That's just a really practical way of doing it. The idea is you've got that confirmation. Now let's look at this from the other angle. Let's say I come into the day and I'm really biased. I'm biased to the short side. Okay? I'm biased to the short side. And I'm looking for an opportunity to sell this thing, and I've missed an opportunity here, and nothing's going on here. And it starts to rally up. It starts to bounce, and maybe I'm looking to a retest here. Okay, that's actually not a bad place to look. Well, what have I seen? You know, this thing's rallying pretty hard. Not much. It's showing some momentum. I've got buy volume imbalances, and you can either, you could take the trade, but boy, I tell you what, as soon as I see this 3 ticks, 4 ticks above me, I got to get out because I'm wrong. I'm most likely wrong. So that you could use it that way, or you don't. You wait for the trigger. You wait for this. You wait for the sell volume, sell imbalance to come in. And you just, I don't mean to oversimplify it, but honestly, let the information speak to you. There's a lot that's gone into it. Let it speak to you. Learn to read it, learn to listen. Don't force your ideas on the market, because that doesn't work for anybody. I guess unless you're the Fed. But that's it. Here's another example. This was the ES. This is an older screenshot. And so we had a move up. And look at these. You can see these yellow boxes. Heavy buy imbalances here on those 2 bars. And if you see that, there is probably more to come. I mean, there's probably more to come, because you don't see that very often. And so what's it tell you? Well, it tells you don't look for shorts. If anything, you should be looking for longs. Right there, you've eliminated the possibility you might get short, and you're looking in the direction of the strength, which is the idea. You want to be on the strong side, because the strong side will win. That's the way it is. So we got that. And then we got the breakout. This is just the continuation, and you can see, I mean, this was a strong, heavy buy volume imbalance move. And I love it when it's that way, because it makes it easier to ride just stick in the trade, because you just feel like there's either some stuck shorts and they're covering, or there's news, there's something going on, and the market it's moving. It has a strong directional bias, and it's being conveyed price by price within these bars on the footprint. Candles would not show you this information. So it's followed, you get this follow through, and it's not until this bar. Let's take a look at this bar, because it's one thing to be on the trend, it's another thing to, when do I get out? When do I exit? Well, you exit when you start to see what took the market to that level be gone. What do I mean by that? Well, look at all the buy volume imbalances. If you look back on every bar, now this was congestion, but these directional bars, there was heavy buy volume imbalance. Here, there's actually 2 sell volume imbalances. So if nothing else, maybe that's a decent spot to try and take some off the table. Either close your position or eliminate. I'd definitely take something off the table there. And you can see I don't got a level here. I don't got a zone, but all I'm using is the price and volume and order flow information to say, you know what, the market at least in the short term has exhausted the move up. It's a good point to just take off some profits, and even if it were to go higher, there'll be an opportunity to get in. You can reload, but there's nothing wrong with locking some profits in. And this is how you can do this. This is how you can read this data. Yep, this good point, John. This was an overnight. This is a London session open, it looks like. Okay, moving on to the next slide. This was, when was this? I think this was Valentine's Day, so last week. And what am I looking at here? This was, we're talking about the trends. And again, the same things apply that I've been talking about. I mean, I had a support level. Market was dancing around it, through it. But finally, remember, this is support. So I'm looking for buys. In support, I'm looking for buy opportunities. In resistance, I'm looking for sell opportunities. So all these, these here, I'm not too concerned. It's random. I'm not participating, I'm being disciplined. Trades down here, we get this. This interests me a little bit. It's a new regular RTH low, new low for the day here. Trades back up through it, back in, and I get these. Lights up with a couple buy volume balances. That's, my interest is perked, and I'm possibly entering here. But then once it starts, say you do get in, it's confirmed. I know this is after the fact, but watch this in real time. That's all I can tell you. You really need to watch it in real time. Watch this play out. Watch it at your levels. This here is the confirmation. These are not triggers to get in. These are confirmations that if you're in, if you're long, the market is strong. You're seeing this strength. It's also confirmation that if you're short, you should get out. So that's how you use the information. Hopefully this makes sense to people. At your support and resistance levels, that's where you're looking for these triggers. These trends or these moves up, that's your confirmation. Those aren't necessarily triggers unless you're a large trader and maybe you're adding to positions, and that's a whole nother dimension, which we're not going to get into. Market trades up, and we call this a ledge. And I just call it a volume ledge, where the market will bounce. It's going sideways. Notice, what do we see though? Buy volume imbalance, buy volume imbalance. I'm not seeing the selling in here. And it's building this ledge. This is key. This is key. I need to see this to hold. I'm usually willing to give it a few ticks on either side of it. But it's building value up here at this level. There's a lot of interest at this price, 28.5. Buy volume balance, and off to the races again. Okay, and let's see, I think I've got, this is the last example, and then we'll move on here. So this was obviously a pretty strong downtrend. This obviously is an older screenshot. This, I recall, this was another trade that I took, and I had gotten short, I believe, on this bar. And the reason is this was the RTH high. I was retesting the high of the day, and I've got this sell imbalance. That's just what I want. It's what I want to see. I want to see reaction at these levels. So in this case, it wasn't so much support and resistance. It was just a retest of high of the day, and I saw sellers enter. And that's a trade I'm willing to take because I'm wrong. If the market, I'm wrong if it gets up in here, but I'm willing to see what happens. See if we get some follow through off that level. And you can see this. Let the market speak to you. Let these bars, you can see inside the bars, and let them talk to you and use them appropriately. It's not a red light, green light system. Going back to 5 minutes ago when I said At your support and resistance levels, use it as triggers. On trends, use it as confirmation. That's important. Okay. In summary, for these some of the benefits of this, if you haven't seen them already, it's easy to understand and trade with. There's not so much interpretation. So if you've used the footprint in the past, and this is obviously new, you can see there's not near the interpretation. It's much more, it just tells you. You can see what's going on. So it's a matter of how you apply it. Helps you identify that trend. Use it to confirm. Don't step in front of a freight train, a trend, a strong trend. Don't step in front of it. You don't have to be on the trend. If you're not on a trend and it's going, say you thought it was going to go higher, you didn't get in and it goes. Should you be mad at yourself? No. But certainly don't step in and try to sell it because you didn't get in and get long. Just, you missed that one, it's okay. Live to trade another day. That's the most important thing. Confirm support and resistance levels. I've probably shown you 20 examples, and it's important. You really just need to try it out and see. Intrabar information. Be ahead of the competition. As I said earlier, your small subset of the trading population at large, most people have no clue of this. And so it is a clear edge. It's a clear information edge. There's no question. And so it's a matter of getting it up on your screens and starting to apply it.